My guests today is Sameer, Rizvi and Iryna Dubylovska, founders of RDCP. Over the past 8 years, they've made 31 investments that have been consolidated into 12 companies, employing a total of 2,000 people, a combined 400 million of revenue and 40 million of EBITDA. Thanks a lot for coming to the HoldCo Builders podcast, Sameer and Iryna.
Thank you. Thank you for having us.
Thanks for having us.
You're still in your 30s. Do you sometimes pinch yourself to realize how far you've come?
It sometimes feels like we are old now compared to when we started.
Yeah, we started early 20s, me and Iryna. No, we feel appropriate. We feel like exactly where we're supposed to be, I think. But probably also because we've got 4 kids, so it
ages you.
Yeah, you don't feel that young anymore. But I do get what you're saying. We do a lot of comparison to various investors. I'm very interested in age and because I mean I know you're a huge fan of Buffett and Munger and so on, but one of their key things is start early, and then the only way to build a lot of wealth is to start early and then let it snowball. So I focus a lot on where we are in the journey, age-wise, both our age and then company age, but also where others were at the same time back in the day. So I try to, as best as possible, and the information is limited, of course, but where possible, I try to see where certain people were at certain milestones for their age. And then in today's dollars or today's pounds. So yeah, we do focus on that a lot. But yeah, no, we're pleased with the progress and hope next year is our 10-year anniversary. We're hopeful we'll hit a certain number that we're really targeting hard. And so yeah, that's the big focus for next year.
And as you're both here today, and as this is a family business today, we are going to see who really wants to talk and shine and who's willing to watch and listen.
Yeah, Sameer loves to talk, so that one is an easy one.
Well, we're we have different skill sets as well, right? So I am more of the, I guess, outward-facing CEO type, but really all investment decisions are made together. All decisions really are made together, and we consult each other all the time. We rely quite heavily as well on our senior management team. So yeah, we try to create as much of a meritocracy as possible at RDCP.
Okay, so you started in your early 20s back in summer 2015. What were you doing before starting it? And maybe you can share the origin story, the one I found in your 2019 or 2018 annual letter where you went very specific, like how much capital you both pretty much got from your parents and how you went.
Yeah, so we met in our first job. That was at RBS. We were both analysts. We met basically 1 month into the job training. So it was at the job training. And then I come from an entrepreneurial family. So my father was an entrepreneur, and I kind of went into banking thinking that that's just a stepping stone to become an entrepreneur later on, just to learn the hard skills, kind of the modeling, how to evaluate the business, etc. But I always had this idea of setting up my own business. And when I met Sameer, he had a similar idea of kind of banking is just for a little bit. And then it's all about creating your own business. But he had the idea of doing it in like 10 years. And I think
10 years later.
Yes, 10 years after 10 years of career in banking, whilst I had the idea that maybe let's do it sooner. So yeah, that's how we met.
I forgot about that. Yeah.
Yes.
Yeah, it was Iryna who pushed to do it. Because I thought... And I remember I had this little note where I was like, yeah, I'll do 2 years banking, 3 years private equity. Around my age 30-ish, we'll launch something. But I think it was Iryna who said, how much more credible are you going to be at 30 versus 22? Maybe marginally more, but we're going to face the exact same challenges. So...
Yeah, and I think a part of me was thinking also the older you get, the harder it becomes because then you have a mortgage, then you have kids, then you have a family. So the risk becomes much bigger, of leaving your job and starting your own company. Whereas when you're 20-something, we didn't have much to lose. We had a salary to lose per se. Yep. But then again, you can rejoin the bank if, it doesn't work out after a year or two. So yeah, I think that's how we took that first leap of faith and it kind of worked out.
Yeah, absolutely.
And what about the financial risk? I mean, sharing this idea with your parents that, okay, we have our jobs and now we don't want to have our jobs and we would like to move forward. What was the reaction, and how were you able to? Because I guess the first sale you did between each other, and the second one was your parents, so you could move on with the first acquisition.
I think, I'm going to talk about my mom. My mom wasn't very happy about that. She wasn't very happy about me leaving the job and also starting a company with someone who I knew only for about 9 months.
Yeah, we knew each other for 9 months.
So she wasn't very happy about that. But then, what are you going to do? She was like, she's going to try. If it doesn't work out, it doesn't work out. She's still young. She can go back to the job. But yeah, I think both our parents were a little bit taken aback by us doing that.
I don't think I told my dad for a few months.
Yes.
Right, I kept it quiet, and then you told me to tell him. Yeah, it was a whole thing. I mean, in hindsight now, it's like, hey, who cares? But at the time, it was a big thing. Well, the other reason it was a big thing is because we did need capital, no matter what. And at the outset, we thought we'd go raise some from family and friends and become, even if we were not going to per se become a small private equity fund manager, we thought we should go raise some money. Because we were unsuccessful at that, because who's really going to give much capital to kids in their 20s, early 20s? We ultimately, our startup capital really was, I took pretty much all of my dad's savings, and I'm not sure why he did that, but I think I know why he did that. The main reason he did that was our first acquisition was going to be in asset-backed care homes, asset-backed healthcare. So that's freehold real estate care home, a single care home. And I think really, applying a bit of logic, he thought, how bad could it go? And then Iryna contributed through her late father's, you had a bit of inheritance left.
Yeah.
And so, that was our startup capital. That was around £2 million, just over £2 million.
Yeah, so we bought our first care home. Yeah, that's what we invested in. It was a care home. It was still owned. And actually, the manager of that care home, she is currently our managing director of the whole group, of our RDCP care group.
Yeah.
She has progressed with us, and we know her for 8 years. We bought it by
8 years. Yep.
8 years.
Yeah. So that was how we started.
And how was it? Did you leave before you found the deal, or you decided to leave and then you were like, okay, we got to go all in and we have to find the first deal? Or how was it? Because I think it's very important, this period, like how quick you have to get it done.
Yeah, I think RBS, when we joined it was not a very good investment bank at that time, to be honest. It has lived already through its kind of high times when it was very big and they were doing a lot of deals. Like I spent 1 year there, and in 1 year we didn't close one single deal. And I was in a corporate finance team. So it was a bit disheartening, I think. And we have decided to leave just to invest all our time, but I think also subconsciously to put the pressure on us, because if you're still working in a full-time job, first of all, you have very little free time as an investment banker. And second of all, it's not the same drive that you have, because you still have that, fallback of job just in case it doesn't work out, etc. So I think leaving the job was like a big push for us as well to we have to make this work now.
Yeah. So no, we went all in, Mick. I quit, and then Iryna quit within 3-4 weeks after me, mostly because I was getting bored on my own. It's the first time being all by myself. So Iryna joined me very shortly after. So yeah, we both quit nearly 9 months before, or 12 months before we did our first acquisition. So yeah, we went all in.
Yeah, and we had identified an acquisition fairly early on, but it didn't work out. It didn't work out in a very hard way, I think, because the lady who wanted to sell the care home, she decided not to sell. So it was literally...
She decided not to retire.
Yeah, she decided not to retire.
3-4 months into the deal process, so we lost
a lot of fees, and it was also about 2 weeks before we could sign on it. So it was very disheartening at that time. It was a hard kind of punch in the face, I think. And that was also the time when I remember we're reevaluating, and Sameer was like, maybe we should go back to the jobs, maybe one of us should go back. But we have decided to give it another try to see if we can acquire another care home, and that one worked out. And that's Kings Bromley, which was still owned. That kind of gave us the confidence that we can do it again.
So the one that worked out, could you share the details? Did you acquire 100%? How much debt you used? How much seller financing? Can you share any details?
Yeah. So in the care sector, in the UK care sector, there's pretty much no seller financing. it's the deal structures are, because you're essentially buying real estate, and although it's an operating business, it's pretty much the only sector we've interacted in and invested into where it's 100% of completion, and there's only so much leverage you can use from the lender. So it's quite a traditional sector, which is why it keeps away. It pretty much only attracts very professional investors. So we were I don't know how we managed to sort of muscle our way in, but today it's a very hard sector to break into because a bank will not lend you more than 65% of the purchase price, 60 to 65%. And so you have to fund 30 to 35% to 40% in equity. You will not get seller financing for that shortfall. It just doesn't exist. So the deal structure was, I think we paid $2.5 million for that very first care home, pounds, and our equity check was 40% roughly, whatever that maths is on that. So about just shy of £1 million, around £1 million. Yeah. And then our very first lender who ever backed us was a bank called Allied Irish Bank. Yeah. So they helped us buy our first 6 care homes. He then moved the relationship to Barclays, and subsequently we've done some amazing things with Barclays, very, very supportive lender, great pricing, very simple structures, and a normal group of people, smart group of people to deal with. Yeah. And to be fair, now for the first time in 2025, we're hopefully going to become a multinational HoldCo conglomerate because we're hopefully closing 2 transactions in Ireland. Mm-hmm. The first time we're earning or investing in euros and not pounds. That's quite exciting. And hoping, the reason I mentioned that is we're hoping to work with Allied Irish Bank again, given it's Ireland. So, yeah.
And the lenders on the first deal, how many did you talk to? Like, was it numbers game or you were just talk to 5 and one was, okay, let's do it?
Yeah, it was I think we worked with Christie Finance. We worked with again, we had limited relationships at that level, or any relationship really, but certainly at the mid-market or small cap care home acquisition level, we didn't know which banks to approach, which bankers to approach. So we worked with someone called Christie Finance, who were debt advisors specifically for the care sector. And they helped us out. So they introduced us to a number of lenders. Of course, naturally, first-time buyer, super young, limited capital behind us should things go wrong. So not much of an ability to equity cure, all those kind of issues. It was very tough. I mean, naturally, it's obvious that it was tough. And so, but somehow we got a particular banker at Allied Irish Bank quite comfortable with our investment strategy, our approach, a guy called David Booth. And you really just need your first deal. Once you have your first deal, if it goes reasonably well, you can grow off the back of that, generally.
And once the first one was done, what was the plan post-acquisition? Did you want to grow it organically, or you knew already that you're going to acquire additional businesses in this sector, or what was the additional plan?
I think about the care homes. You can't really grow them because there's such a much beds in the care home, and if they're all filled, they're all filled. So unless you're gonna develop the care home, build some additional rooms, build some additional space, etc., you can't really grow it. So to be honest, the only way was to acquire more in that sector.
Correct. Yeah, you either buy or build.
Yeah,
literally. And building is not our game. We've never done that. Acquisitions is so much easier, as we know. So that's what we did. We bought our second care home about 6-7 months later.
Yeah.
And how big did you grow it before you got into other industries?
The portfolio was worth...
It's 6 care homes that we have.
6 care homes that we had before we branch out past healthcare. Mm-hmm. It was about a £30 million enterprise value, roughly. Mm-hmm. So that's about 10 times EBITDA. That's what it was roughly worth. About £30 million before we decided to move into our next sector.
And what was the mindset behind it? I mean, it's just you two owning 100% of it. What did you have any deal between each other that when are you going to pay a higher salary or taking some dividends, or what was the plan? Because I know one of the interviews you shared that you've always been not wanting to give up the lifestyle when it comes to building a business. So what has been the thought process behind this?
Our lifestyle improved with each
acquisition.
Pretty much with each acquisition. we were also when we had Victor after.
We had Victor and our first son in 2020.
Yeah, so the cost base changes once you have kids, as you know. So, but no, yeah, we've again, it all depends on what kind of deal you structure. So in certain acquisitions, pretty much all of the free cash flow is taken up by servicing lender debt and then servicing vendor finance. And in which case, there's pretty much nothing you can take for 3 to 4 years as a shareholder or as the holding company. But in the care sector, given the type of transaction I just told you about, which is pretty much 65% senior debt and nothing else, and because it's a real estate style play, the amortization of the debt is like 20 years. So there's reasonable headroom for you to be able to, as long as you're meeting covenants and the bank allows it, you can pay management charges, dividends, distributions, that kind of thing. So yeah, we did all right over the years.
So 6 care homes in the portfolio. What was the next business you acquired? What was the next industry you pursued, and why?
We jumped into engineering / infrastructure / construction style businesses. So these are reasonably small subcontractor style businesses, predominantly because they were cheap. They were fairly inexpensive. But that wasn't the right strategy. So in hindsight, and we now know how to play in that sector. We've just bought a business called MCS Group, and we acquired that literally 3 months ago.
In October, yeah.
In October. Amazing business, 130 million pounds turnover, and they do about 8 million profits on that 130. So relatively low margin, but still a very, very sizable business. And that's the type of business one should invest in. If you're an investor that wants to play in the home building or main contracting or any kind of large structure development game, that's the kind of business you want to buy. And that's a very professional business that's run incredibly well with a very strong senior management team who are super well seasoned. We at the time, so post healthcare, we entered the sector, but we were looking at very small subcontractors. So they might turn over okay numbers, 10 million, 12 million, 5 million, 8 million, but they were making very low margin, and it was essentially, yeah, these weren't great long-term businesses with much of a moat. So it was useful. It was a sector we entered into. We made a little bit of money. Some of them we exited back to the ex-vendors just because they weren't right long-term businesses. But really, beyond healthcare, the main sectors that we've expanded into are industrials. Now, industrials is our single largest sector today. And that's a very large catch-all term that includes a company like MCS, which is infrastructure, main contracting, construction. It includes engineering businesses, includes manufacturing, it includes electrical products distribution, facilities maintenance. So that all of that, we own a number of businesses in these various sectors. All of that we sort of collectively call industrials. That's our biggest sector. Our second biggest sector is healthcare, of course. And then our third sector is consumer, which is predominantly consumer staples. So that's a food distribution business, a grocery food distribution business, and a soft drinks distribution business. So yeah, that really today, and look, as I said, I'm writing my annual letter as we speak. These are the 3 sectors we like the most. And by the end of Q1 2025, I would expect probably 50% industrials, 25% healthcare, 25% consumer. That's the rough split of the portfolios. It's quite a nice balanced portfolio in sectors of businesses that are relatively critical to the British economy and support services of the country. So they're fairly there's some cyclicality and some seasonality, but they will do reasonably well in most economic environments. Yeah, that's sort of, so sorry, I've answered your question in a way that beyond healthcare, that's kind of where we expanded.
So the first 2 to 4 years, did you receive any offers from private equity to sell the holding, or you already knew that, okay, we're going to go and build this for another 10, 15, 20 years?
Yeah, I think that actually the long-term view in terms of holding the companies for forever, as we say, came from the care home acquisitions. Because as we acquired our first care home, I remember when we went in there and we did like a speech and people were asking us, is my job safe? Are you going to sell again in 3 to 5 years? Just because the first care home we bought was a private equity, I think, exit.
Private equity backed.
Yeah, private equity backed. So they've been sold 4 years after the acquisition, and that made us think that if the asset is doing well, if the business is doing well, why would we sell? Because this is our money, right? We're not giving anything to investors. We don't have any investors behind us. We're not investor backed. So it's our money. If the business is doing well, we'll just keep it forever. And that's kind of where this idea of permanent capital came. I think it came from the care home acquisitions. Also because these businesses are very, very stable. And it continues. So now, as we grow, we also look only into stable businesses, established businesses that have been there for years, a proven track record of, good returns, and we just buy them and hold them for the foreseeable future.
And of course, it's the right thing to do for returns and for long-term wealth creation, to hold these businesses long-term and allow for very long-term compounding, Berkshire Hathaway style. But the second reason we did it was because there's very few people that are doing it, and certainly not at our scale in this country, at least. So when we were, and even today, especially now, we're in such competitive, every deal that we're trying to buy, and these are our average deal size now is, when I say deal size, I mean EBITDA size of the companies that we're buying is about £4 million. It's probably the average today. And these are competitive processes ran by EY, Grant Thornton, mid-market, well, either proper corporate finance houses or corporate finance teams of large accounting firms or small investment banks. So these are all fairly competitive processes, and we're competing with private equity almost every single time. And over time, that became our unique selling point. How do we convince a group of relatively wealthy shareholders of a company to sell to us instead of to private equity? And look, private equity might offer 5% more, 10% more than us. What's our unique selling point? And the unique selling point is that this is indeed a long-term, not only is it a long-term permanent capital type business model, which it is, it's also a family business. So it's husband, wife, we got 4 kids, we want them to join in the future. And that's really our ethos. Like that is, and it's not even a marketing thing, this is who we are.
Yeah, a lot of the businesses that we buy, they are from people who are retiring. And people who are retiring, they've built those businesses for 20 years, 30 years. They don't want psychologically even, sell them and then seeing them sold again in 3 years and in 5 years. It's for them, it's disheartening. So that's why they pick us, because we have this long-term view and we're going to take care of the business for the foreseeable future.
I think in these meetings, by the way, Mick, we probably don't even sound like the private equity guys, because the private equity guys, they've been doing it for a while. They've done their years at some American bank and then a well-known private equity firm. So I'm sure, and again, we're never in the same meeting room, but I'm sure we just sound different. I bet we just come across so different because we started so early. We didn't get a chance to be trained or brainwashed and to speak in a certain way. We speak how we speak, which is quite authentic, really. And yeah, it's so at the beginning, it was kind of like, hey, we're different from private equity. Over time, we're just telling them the truth. And it has become our strongest selling point. Which is predominantly that this nice business that you built is not going to be a vehicle just for us to,
extract value and sell in 5 years.
Yes, this is now a long-term, important key part of our business. It's a business unit of RDCP, and we're going to look after it for 30 years, 50 years, that kind of thing.
So when it comes to building deal flow, is there a list of brokers? Do you have someone on your team who's calling to potential sellers? How does it work? Because there is a Swedish holding company, RoCo. I think they said on the interview that they have relationships with 1,000+ brokers, and they had one deal in UK, which they, I think a few years ago, bought. There were 37 bidders on one business, and they won because of pretty much the same reasons you have, because this long-term mindset. They're not a family business, right, but they have this long buy and build strategy, and that was the reason they won. So coming back to the question, how do you find the best deals?
We've did you want to take this? Or
you can start.
Yeah, we so our big part of our secret sauce is that deal origination is part of our secret sauce, and it's a part of the cycle of RDCP that we control. So Iryna and I very much manage and control the deal origination, and it's not something we have yet fully delegated or brought someone to handle. So we've got a couple of investment directors who assist with winning a transaction. So we've got Paul Clun, who looks after the industrial sector. We've got Rosie Howell, who looks after healthcare. And of course, they each run their respective portfolio companies. But we bring them in when we need sector expertise, when we need somebody to go and visit and sit down with the management and speak the same language. But really, deal structuring, deal sourcing, having those relationships with small corporate finance firms, medium-sized investment banks, and so on. Me and Iryna hold that close to heart still, just because that is, that's how you put food on the table, and we enjoy it. I genuinely enjoy deal making. It's good fun.
Yeah.
It's not something I would necessarily give away.
Yeah, but I think in terms of sourcing a lot of deals, they come to us now just because of the news that come out of the deals we have done before, and because we have become established enough and known enough in the market for people to reach out to us.
Yeah, so we to be honest, Mick, we don't do too much outreach ourselves. We have a probably list of 30 or 40 corporate finance firms across the UK that we regularly interact with, and occasionally we'll send them hey, we just closed this deal. Mm-hmm. Here's our updated group pack with what the portfolio looks like, numbers, etc. Anything of interest, please let us know. This is our criteria. So we'll do kind of like outreach like that. But really, we've predominantly, almost everything we've bought and continue to buy are seller-initiated marketing processes where they've appointed advisors. Yeah. We've tried a couple of times to do direct outreach to businesses that we find interesting, but that's hard. It's
we haven't ever succeeded yet. Maybe at some point, but by directly approaching
consumer brands, local businesses that we've come across where we think, gosh, that's a great business. Let me write to the owner. It's
things that for that approach, the timing has to be correct. So the person has to be willing to sell, and also the price has to be correct, Whilst if the person is already looking to retire, for example, is motivated to sell, then I think the price becomes attractive to us.
Yeah.
So I'm here doing this podcast in order to learn from you, learn from other builders, attract investors. This all has become true. One of the things you've said on the annual letters is that never waste cash flow on awards, conferences, or other networking events. And the message probably behind this is that just do the work, and the work will take care of everything. But here you are today in this podcast sharing your journey. But I'm pretty sure this has now changed when it comes to the first 3 years, and now when you're a well-known brand on the industry. So maybe what are your thoughts on this world where everyone wants to build so-called in public, sharing their journey, versus being fully focused on finding the absolute best deals and getting it done?
I think well, I don't know if I said that, but I do still believe in that, and so does Iryna, I'm sure, whereby the main way to win is to win, and that can only be done by buying a good business and doing well with it and supporting that business. That's the primary way to succeed in building a HoldCo. But look, building a brand around yourself as a CEO, around your company on LinkedIn, Twitter, etc., that's valuable. It can attract deal flow. It can attract investors. The guys who run Roll Up Europe, they're doing something quite smart in the way they're doing it, because obviously they're both building Baltic HoldCos themselves. But they've got this pretty cool, network and community of people like you and me doing this too. So I think what they're doing is pretty cool. But my message, that old, I guess, quote or whatever I put in an annual letter, that still stands true. I mean, don't spend £1,000 or £5,000 at some conference to buy a table just so you get some award. I believe that it's not 100. There's no. Yeah.
Yeah, I think also a lot of people go to like a networking event, pay for it, and they think some magical thing is going to happen to them all of a sudden just because they went to an event. But you actually have to do the work, You guys going to an event and just meeting interesting people is not going to take off your business. You actually have to do your own business. And also through doing that, you're going to meet interesting people and build your network.
Yeah. I think winning, i.e. doing a nice transaction, and then being loud about that particular success is one of the best ways to do it. So that's how we've built a brand, has been pretty much that. We haven't done any acting. We've never done any marketing. The only time we spend money is on acquisition PR, which is about £400. So it's negligible. It's a lady who we work with every single time. She creates a press release. It goes out to the various media outlets in the UK. And that's it. We then post about it on LinkedIn and
Yeah.
That's pretty much it, and that's been the driver of our brand and then consequent sort of additional deal flow.
So you mentioned doing these nice transactions. Can you maybe share some of the, because in the beginning you also mentioned that you're doing these extremely complex deals where oftentimes not too many investors are even not getting into. So maybe you can share one specific, like a structure, going as detailed as you can, of one of the acquisitions you've made, which turned out to be very successful.
Because you said very complex deals, I don't think the deals that we do are complex. Actually, we have concentrating on buying only businesses that we understand. So if there are businesses out there, for example, that are things that I don't understand, we wouldn't exactly invest in it. Just because fully understanding the business means that you will be able afterwards to fully integrate it and be aware of what's happening in it. So there cannot be some complex things that we don't understand.
Yeah, we've learned that the hard way, where we tried to get into certain transactions which looked attractive, but we didn't really fully understand what they actually did or how they generated their revenue, and that's bit us in the backside subsequently. But so yeah, no, Iryna is absolutely right. I would say our transactions are simple. The businesses that we're buying are simple.
Yeah,
I could explain them to our 5-year-old. Really, every single business can be explained to our 5-year-old, and I think it's important to be able to do that. And then the deal structures are pretty straightforward. So, we're buying, depending on the sector. So healthcare, it's always 100% acquisition. There's no need for a handover. There's no need for retained equity, rollover equity from the ex-vendors. It's just not needed. In some other sectors, we just bought a amazing business called Grayton. Grayton Limited. We closed on that 2.5 weeks ago.
Yeah.
The press is out yesterday. I think it went live yesterday. Amazing business. We acquired 80%. They do very essentially engineering services. So it's low capex engineering services. And they're based in the north, but they work across the country. And they service sort of old school, old economy sectors. And they're very unique at what they do. The 4 sort of senior management are all very smart engineering types. One of them is more a finance person. But in a situation like that, retained equity, being partners with the younger shareholders is absolutely key to making the transaction work. So Grayton, as an example, we acquired 80%, 20% rolled up shares. Some earn out, not a huge amount, but there's an element of the purchase price that's an earn out. The senior debt, the purchase price was funded partially by equity by us, and then Beach Point Capital supported with the senior debt check. Mm-hmm. So yeah, that's a decent example of a.
Yeah, and also the businesses that we'll look into, they're not in the hot sector per se. So I remember when we started, we were doing healthcare, because care homes are healthcare. I remember talking to one of my friends, and I was like, "Yeah, we're starting in healthcare." She was like, "Oh my god, pharma!" Because that was the hot sector to be in. And I was like, "No, care homes, maybe a bit less exciting." So the businesses that we look into, they're established, old school businesses, and there is some competition in deals, but there's not that much competition, and that's why we're able to buy them for good price.
Consumer sector businesses. One we've just won through EY in Birmingham. Amazing transaction. It does about 7 million in EBITDA, and we're hoping to close by March or April. That was very competitive. And again, the reason we won that was purely because of what we talked at the outset. It's a family business. They have multiple family members working in the business. They met both of us, and the unique selling point was husband, wife. We're essentially a private equity firm. We're doing private equity style deals now, and the size of deals are much larger than we used to 2, 3, 4 years ago. So we're competing with private equity, but I don't see, unless you tell me, Mick, I don't really know of anybody else who sort of self-funded HoldCo of our size. So it's helping us win some of these nice businesses, which is competitive, but we're winning them now purely because of our of who we are.
Yeah, and we're the ultimate decision makers as well. So we are the ones who decide whether we're going to buy it or not buy it. So it goes quite quickly with us, because once you have decided you want to buy the business, you can just go on and do the deal. Whilst a lot of the times with private equity, it takes them a while. They have to go back to the investors. They have to do, a lot of DD, etc., a lot of due diligence, etc. Whilst with us, it's quite concise and it's quite quick as well, which sometimes attracts some of the sellers as well.
Decision making is much quicker. We have our own investment committee, of course, but it's not the level of bureaucracy a private equity fund would have, and the capital calls with investors and so on. So yeah, those are some of the reasons we're finding success.
And how often do you disagree between each other? Like when it comes to a very attractive deal is coming on the table, and for various reasons, one or the other decides to, no, we shouldn't do that. How often does it happen? And maybe what are the reasons?
30% of the time, right? 20-30%.
Yeah.
Which it's not even disagree. I take Iryna's opinion on very quickly. So it might look attractive, but Iryna quickly finds the potential pitfalls. And to be honest, most of the time I don't argue back, because we wanted there's sufficient deal flow here. UK is a very active M&A market. There's more than sufficient deal flow that if anything is a maybe, it's just not worth it. Plus, we've been on the other side of managing a distressed business, and it's just such a time-consuming biggest waste of time in the universe. So
it seems appealing, but as you go into it and you try to manage it, all of a sudden you realize why it was so cheap. Just because it requires so much capital and so much time to invest and so much turnaround expertise, which we don't necessarily have. So those type of distressed businesses not something that we'll go to anymore.
And or a business that seems attractive but potentially could have signs of distress or could become distressed. So that's typically where I might say, hey, this looks all right and decent on paper, and that's where Iryna might say, actually, it's just not worth it, and we don't. So I would say those are minor differences, but very quickly I'm on the same page as Iryna.
And when was it when you decided to get into these distressed assets, and how quickly did you realize that, okay, we should, I don't know, get rid of this and never do it again?
We didn't do much of it.
We haven't done too much. We bought something called Chilango, which was a Mexican restaurant group, owned it for 2 years before we sold it to Tortilla.
It was a good exit, to be honest.
That worked out well, but that was a rare example of things working out well and for distressed, at least for us.
Yeah.
We did a successful corporate restructure of an engineering portfolio that we bought, where we kept two of the strongest businesses and we refinanced with a different bank, and that worked out well, and thank God. But it wasn't worth it. Just not worth it. I compare that to the amount of time we spend back to this UI deal, or even Grayton, which the Grayton process took 4 months start to finish. Amazing business, MCS, 8 million annual profits, amazing business. That whole process took 3 months. Just not worth wasting time on distressed stuff. It's just not worth it. Unless you're into that kind of thing, and there's certain investors who are, and you want to go spend 5 days living in a hotel next to the company, and it's just not. I'm not into that. And it's a Buffett approach. If you think about Berkshire's approach, I think he said something, something along the lines of, walk over 1 foot poles instead of trying to catapult over 8 foot high poles, that kind of thing. And that's what distressed investing is. It's just so much effort, and maybe overall you've paid like 3 times EBITDA or 2.5 times EBITDA, so it just seems cheap over a very long time horizon. But UK assets are reasonably inexpensive anyway. Structure the right deal with a bit of risk sharing between buyer and seller and lender.
Also, I think it also goes a little bit against our seasons, which is, holding companies for a long period of time or forever, because if you're not able to turn around their business, that means you have to close it down. And that kind of goes against what we believe in.
Yeah, in a way, it starts to hurt our
overall reputation.
It's just not worth it. Yeah. So we've tried it, and look, like most things, our principles are formed by doing and learning and making mistakes, and that's how we've gotten here. But yeah, there's no point in doing any distress at all.
So post-acquisition, CEOs, management team, how ruthless you are and how ruthless you have to be when it comes to changes, or how many changes have you made before? Because I guess this is one of the things what the sellers appreciate when you don't change too many things compared to private equity. So how has it been in reality for you?
Yeah, so far we haven't done anything, to be honest, with any of the businesses we have bought. So we haven't massively fired or anything like this, like some private equity companies, they're famous for that. We haven't done anything like this. So we would buy a company, the previous owner would exit, there would be already a management team in place, and those people would just be promoted to CEO, etc. I think next year, and it's actually our goal for next year, is the first year when we're going to consolidate. And consolidation is the key word. for us for next year. So instead of being this holding company that we are with different businesses, we are gonna consolidate the businesses and become more of a conglomerate. So that's our idea for next year.
Yes, we've done well in our 9 years of, just to reiterate what Iryna is saying, our motto has really been, work with smart people and then don't get in their way. So you hire or acqui-hire smart people and then don't get in their way. And that's worked well. And we've done reasonably well. And we've been able to grow, and we've been focused very much on deal making, and then the running of the companies has been left to this, decentralized to the management teams. But the integration is what we want to do in 2025 and 2026. So, and that doesn't mean, look, these are businesses in fairly diverse sectors, so industrials, healthcare, consumer. But what we want to integrate is, and start to act like more of a single corporation, is a central finance function, a central HR, central IT, payroll. These 3 or 4 functions we want to start with and see what it looks like. In simple terms, it should mean some cost synergies. You would think there's some obvious cost synergies. But then beyond that, we want revenue synergies where there's still some leakage between the companies, where we're using a third-party contractor instead of someone within the group. So we're hoping to solve for certainly the cost synergies and a central function or central functions, as well as the no leakage is a big push.
Yeah, there are definitely a lot of synergies between the companies that we own. We never just looked into extracting those synergies and kind of putting it all together. So next year is the first year when we're actually going to do that. As Sameer mentioned, there's a lot of cost saving, but also the companies could benefit from each other more than currently benefit, just because those synergies haven't been extracted.
Yeah. And hence we're trying to bring on we've got 2 CFOs in mind, but we're looking to bring on one of them, of course, for a group CFO function role, and a big focus will be 20-30% on acquisitions and acquisition due diligence and so on, but 70% of the role will very much be group integration, group transformation.
Mm-hmm.
So have you ever made a mistake of buying a business which is too small?
Yeah. Yes, absolutely. There's a few businesses. Yeah. Some of them we don't own anymore. They were just way too small, especially as the group grew, that we exited them back to the previous owners for not that much money. They were pretty happy.
If you're buying a business as a bolt-on to one of the businesses, then it's okay if it's small. But if you're just buying it by itself and it's small, then I think it's a bit of a problem that we will not do it again. Let's put it like that.
Yeah, moving forward, we're not looking at anything under 2 million EBITDA. And very shortly, when we execute our pipelines, we've got 5 live acquisitions and they should all complete by April, I would think. Once we complete on those, I would increase the minimum to 3, I would say, right? 3 million is
probably,
just to, each acquisition should move the needle a little bit. And sorry, these are all in pounds.
So 12 plus companies in portfolio, you own majority, 4 kids. How do you manage it all? Like seriously, like it's a lot of work. Do you have any hobbies, or how does it work?
Hobby? Well,
being with kids is a hobby.
It is.
I think this year is actually the first year where we kind of put some rules for each other in terms of how we spend time with the kids, because the oldest one is going to be 5 in February. And it's kind of the age when he tells you, like, why are you on the phone? Why are you on your computer? It's the weekend, because he's able to understand that now.
Yes.
Whilst before you could kind of be with the baby and also be doing emails, and it wouldn't, it didn't seem like an impact. So now, we do things without our phones, without our computers. We'll go for walks with kids and we'll leave the phones at home, just not to have that distraction, because otherwise there's an email that's going to pop up and you're going to want to answer that email straight away. And it's just going to, drag the whole thing. We try to manage it like this. We always have dinner with kids, unless we're going out or we have an event or something. We would have dinner with kids as a family, all of us. So there are some things that we just, but I think, decided we're gonna do.
Yes.
To get to the family as well out of time.
Yeah. So RDCP at a top co is work from home mostly. So we've got obviously offices and companies across the country, but and most of the type of work and businesses we own, you have to be in the office and you have to make a product or deliver a service and so on. But RDCP at a top co, of course, we can work from home. So our chief legal is in London, so are me and Iryna, but we all work from home. So what that tends to mean is if you're extremely organized, pretty damn efficient, then you could you can do pretty well between being very involved with your work, which you have to be if you're building the type of company we built. But I don't want to compromise with the kids at all. So yeah, I mean, we wake up pretty early. I work out in the mornings, or I do martial arts twice a week in the mornings, first thing. Then have breakfast with the kids around 7:45, 8 a.m. Two of them go to school now, as they started in the last 2 months. We have Iryna and I then do like a no middle of the, so then we do our morning calls, etc. We do a no tech dog walk middle of the day to sort of, that's when break the day right before lunch, and it's just me and Iryna, not very long, about 30 to 40 minutes, and that we discuss business, whatever, but no technology. Then lunch with the kids, more work, and then
Then we do a family walk.
Family walk again. But what we've started to do is when we go outside, so if we're doing a walk in the woods or whatever, no phones, no technology. I used to do that. Horrible. I would get calls, I would get emails that annoys me, and I was, it's a bad idea. So having those boundaries actually is super helpful. It makes it more efficient, clears the brain better. Kids are happy. We're much happier with each other in that sense. There's more strict boundaries. Yeah, it works. But yeah, there's limited time for friends, for example. You can't do all this and have friendships. So we do have some friends, but of course, but it's not, it's not front and center, where it might be if you're a younger person with no kids.
Yeah, exactly. I think kids change the dynamic a lot, with work and in couple as well, because they kind of become the center. You have to build your life around them to some extent, but it's also, they're so young and they're in their golden years that we want to spend as much time as possible with them, but also not compromise the building of the company. So these are kind of the two priorities, and then everything else comes afterwards.
Exactly.
But when it comes to the CEOs, what has been the reason for them to reach out to you or management? Like there is a problem or something, like we need your idea of what to do or how we're going to solve it, or like things happen,
Yeah. Well, I was talking to somebody about this, but if you're a CEO of any company, or let's call it a portfolio company, you're the funnel for the problems of the company. When I don't know, your supply chain manager or whatever, depending on the type of business you're in, reaches out to you, or your transport manager or your care home manager in a care home setting, it's because there's a problem, there's a disgruntled client, some issue with whoever, whatever, cash flow. So you as a CEO are dealing with that. If you're the CEO of a HoldCo or a holding or a family office conglomerate, you're the funnel for the worst problems of them all. So that's just how it is. They're not going to reach out to you if they can solve it themselves. They reach out to you because they cannot solve it themselves, or they need a second opinion.
Yeah.
So you just have to get used to it, which is why the no tech walk, no tech weekend, whatever it might be, becomes so important, because yes, 70 to 80% is fun, deal making, new acquisition, awesome stuff, and it, excites you. But 20% of it is just how it is. You have a large growing portfolio. There's going to be a tiny amount of chaos. It's just how it is. We've come to terms with that, actually. I mean, Iryna and I were discussing that, right? It's just...
Yeah, it's the same as we have 4 children. One of them is always going to be unhappy or crying. You don't know which one, but one of them is something's going to be happening. So it's kind of similar with the companies. One of them, something is going to be not going well, but you just have to go through with it and help out and
be strategic, do what we can, provide capital if they need it, and so on. So those are the kind of problems.
Still, what are some of the lessons you've learned along the way? Something you now know to avoid? One of the things being said is the not getting into buying a distressed asset.
Yeah.
What else something comes to your mind right away?
Many lessons.
many lessons.
Yeah, I mean, like I said, I'm writing them right now. I have a lessons learned section in my 2024 annual letter.
So not buying a business we don't understand fully.
A lot of them are technical things, which I might not write about publicly in an annual letter, but how you structure deals, how much security you give away to a seller, to a bank. All of those things are life or death, basically. You get that wrong because you're super keen to get something over the line, that can bite you later.
Yeah, I think that's an important lesson that we have learned, is that it's protect your current portfolio versus doing a deal, which might jump in the portfolio.
Yes, and we made that mistake in the past, because the banks will throw money at you. we can go raise a HoldCo financing. It's literally called HoldCo financing. You can raise against the entire portfolio. And we could go raise 200 million tomorrow, genuinely based on the size of the portfolio. But we don't want to do it because you're putting all your eggs in one basket, all secured against one single lender. That's the kind of thing to avoid. And it seems simple, but it's not, because it seems very appealing to be able to raise a debt fund, i.e. you still own all the assets and you can operate like a proper mid-market private equity, which is what we operate like anyway. But yeah, so it's saying no to situations like that, which might seem appealing on paper.
It's not to be driven by your ego, basically, and by the idea that the bigger the better. It's about the quality of the companies that you buy and the quality of the management in those companies, etc. It's not only about the size and how big you get and how quickly you do it.
On the last year's annual letter, you shared this is our 8th year in business and the first year where our average annualized rate of return has dropped below a triple-digit internal rate of return, down to 91.4%. You just mentioned the lender side, but how often do you have to say no to outside capital when it comes to equity and doing it even better, faster, and maybe you selling piece of the RDCP?
Yeah, I've had few sort of wealthy friend type folks who always said, hey, cut me into a deal. You guys seem to do some very interesting transactions. And we would do that if we were ever genuinely short of equity capital on a transaction and a bank couldn't fund the shortfall, or I couldn't deal structure the way through seller financing. I would do that. But no, to be fair, Mick, the ones who are closest to us are well aware of our business model, that they know we wouldn't give away. We wouldn't want to go for that structure.
We just have this idea of building a big company, conglomerate, and building it interesting enough for our kids to join when they're old enough.
Yeah.
So, the idea is that we will kind of give it to our children or make our children join the business. So selling a part of it or selling it is not something that we have in our minds.
The only thing we may at some point do, and this is a strong maybe, and Iryna is not for it.
That's where we disagree.
That's where we disagree quite a bit. I'm not necessarily that much for it, but it's got lots of pitfalls. Is going public in the future and listing exclusively on the New York Stock Exchange or NASDAQ. But that's the only maybe where we might float 20 to 30% of our equity. But that would only be when we're like
much later,
200, 300 million EBITDA dollars before we even consider it. But that's a big maybe. It's got lots of upsides where you really become a globally renowned, well-known investor. And then you can build publicly exactly like Berkshire Hathaway. And it opens up certain type of transactions which are closed off to private firms. But there's lots of downsides.
So coming back to the lessons learned and reasons behind our success, you've said most decisions are reversible, and from there you've said unhappy with an investment, try to exit it, unhappy with a recent hire, ask them to leave. What is your philosophy behind this, and how often do you have to do it actually, like getting rid of someone, selling a business? What is the philosophy behind this thought?
I think this thought came probably from a conversation with Iryna where, the idea is the main thing you cannot reverse is once you have a kid for life, right? That's pretty much the main irreversible thing. But I think it was last year when we were dealing with a couple of stressful situations, which were stressing me out in particular. I think it was Iryna who was saying, like, most things you can reverse. It's okay. We'll lose a bit of money, but we'll get out of it. And I think that became quite an important principle, which is like, it's okay. You hired somebody to do a certain role, and actually they're much worse than they said they were going to be in the interview. It's fine.
Yeah, I think a lot of people are afraid to admit that they have made a mistake. And when you hire someone, you think they're going to be amazing, and they turn out they're not amazing. Well, it feels like, I should stick with them because I hired them, and it's okay, it's good enough. Well, it's okay sometimes to admit to yourself, well, I made a mistake. I didn't know how this person was going to be. Turns out they're not a good fit. We're going to have to replace, we're going to have to let go. The same as the company. I mean, now we know the pitfalls, and we're much more selective in the companies that we buy. But it can happen that you buy a business and it turns out that it's not what you thought it was going to be. And that's okay as well. You can exit the business. So there's nothing, it's just, I think you wrote it to to make people realize it's not like the end of the world if you made a mistake in business, or if you hired someone who's not suitable. You can reverse that decision. And as Sameer said, the irreversible decisions are having children. You can't put them back in and be like, sorry, I'm not made for this.
Yeah,
so,
yeah. It's okay to change your mind.
Yeah.
It's okay to change your mind.
So another thing which is very interesting, I mean, you live in London. This is a financial capital of Europe, lots of smart people, lots of brains, lots of capital, but still there is only one RDCP, the one you've built, and you said the lesson, be a player and not a spectator. The lessons learned come from actually being in the arena and not commenting from the sidelines. What do you think is the reason why more people haven't done what you've done? Because I guess you know probably lots of smart people, lots of capital, why they're not able to do this, or what makes you special? Because I'm not looking at you as a god, but you built an awesome business and definitely goals, you know.
He asks me that question sometimes. He's like, why are not other people doing this? I think, first of all, risk. It's a risky thing. So to quit your job and to start your own company, it seems very risky. It is risky. Everyone's going to tell you it's risky. So I think there's a whole stigma and a whole kind of stress that you're putting on yourself, but also other people are putting on you, kind of like, but you're doing this by yourself. Oh my God, what if it doesn't work out? Yeah, and I think the other thing is that people try to build this like 5-year plans, 10-year plans. So I'm going to do this and that and this and that and that and that. And the thing is that once you do one step, the second step might be completely different to what you thought it was going to be. So you cannot predict what's going to happen in 5 years. You cannot have, it's good to have some kind of plan. I'm not saying don't have anything, but to have a very detailed plan, step by step, how you're going to do it and exactly you're going to achieve these milestones at this particular date, it's probably not going to happen. So you have to have a bit of this also like risk-taking ability. And I guess a bit of craziness in you to kind of just jump into it and be like, well, we're going to make it work. We're going to see how it works. And if it doesn't work the way we think it's going to work, we're going to figure it out. So you have to have this ability to be flexible and kind of go with the situation, to be able to turn situation in your favor, to be able to face the issues and kind of analyze them and have a quick solution, etc. So yeah, I think a lot of people from the side, they don't realize that it's not super structured. Because I think the way we grow up nowadays is very structured. Like you go to school at a certain age, then you go to university, then, for example, you go in investment banking, right? It's a very attractive career. It's structured again. You're an analyst, then you're an associate, then you're a VP, et cetera, et cetera. So it's very time, like you 3 years an analyst, then 2 years an associate, et cetera. So it's all like structured. And I think to be an entrepreneur, it's very unstructured, extremely unstructured. So you just have to take what comes to you and kind of react to those situations. And that's maybe it's not for everyone, because that's hard and it's scary.
And I think what Mick was probably also, in addition, referring to is there's a bunch of people, Mick, that you have to be very good and very smart. Our neighbor, for example, super smart guy. 2 doors down, he's raised one of the largest first-time private equity funds in Europe. He's raised like 700 million. I think he's in his early 40s. Very smart guy, went to Wharton, worked at some big-name private equity firms, and then I think he set up his shop 3-4 years ago. Largest first-time fund in Europe. Super successful, investing predominantly in the Nordics. And that's not easy. I can't go do that. In order to be able to sell to the largest pension funds in Europe and Middle East and so on, that's a completely different skill set. And a level of professionalism that I don't have, and we don't have. So that's equally hard. But why aren't more people doing, there's a lot more people trying to play that game, or even if they're building a HoldCo, they're building a HoldCo with a few LPs, limited partners. So I know exactly what you're asking. Why aren't people going for this fully bootstrapped, figure it out kind of
deal by deal,
figure it out? Yeah, and I think it's exactly what Iryna said, which is you have to be a little bit of a cowboy. You have to figure out mid-deal. You've got 4 or 5 or 7 parties engaged, banks, advisors. You're missing a shortfall. There's a bit of cash flow. What do? Stuff like that. We're particularly good at, because we're just problem solvers, and we have learned to create something out of nothing all the time, repeatedly. That is, you can't teach it, but yeah, it's that adaptability. It's that roll with the punches, be a little bit ruthless.
It's luck. I think it's quite
a bit of luck.
Because even to start with, we were lucky that I had that inheritance money.
Yes.
And Sameer's father was open-minded enough to give him some money as well for us to start. So you cannot ignore that. You cannot ignore the starting point in terms of that we're lucky.
We were lucky that we
had
had
a situation like
£2 million of own capital.
Mm-hmm.
We start from zero. And because we had the carry-on base, it gave lenders, as we were building into other sectors, investing, it gave them a lot of, they've got a group of 6 carry-ons, £30 million portfolio. That's all right, So yes, there's a lot of that. And we're also, it's a combination of, I think we understand, because obviously both reasonably well educated. I've got a CFA, etc., and we've done investment banking for a year each. We can talk the finance language, private equity language at a very intellectual level if we want to, but because we understand it at a fairly intellectual level, we can then dumb it down and be able to explain it to a 5-year-old, and that's important. Many people cannot do that, and you don't want to enter these meetings, whether it's a deal negotiation on a business or any of these, and spit out a bunch of finance buzzwords. You want to know that you know that language, you can speak it, but ultimately it just comes down to old school brute force negotiation, and that is, I don't know, it just can't be taught. You just have to figure it out and do it. So that's probably why I don't think more people are doing it, because for an average person, they're looking at a £10 million transaction, and they're like, I need 4 million, 3 million. I can only get so much seller financing, and I can only get so much senior debt. Or it's too expensive because maybe I'm paying 5 times. How am I going to, the bank will only go up to 2 times leverage. Those are true things I've just said, but you can solve for it. And we've just become, as a group, as an organization, exceptionally good at solving for that exact problem. We do that every single day. Decent deal, what's the maximum we're able to pay based on the fact that we don't have LP capital? We can do a certain amount of equity check. What can we pay? Does it work? How can we sell it to the sellers to see this, to show them this is the best deal?
And you said some things you just can't learn, call it talent or luck of knowing it or whatever it is. But what do you consume or study, or who are you? You have conversations between each other, but is there a third party you discuss those things, or how do you stay maintain this competitive edge in this crowded investment landscape we have and you have in London?
We're predominantly competing with ourselves. So that's, yeah. So actually, that's actually a great question, Mick. We're predominantly competing with ourselves. We set our own targets.
Yep.
I've got an Excel file where Buffett was at what age and what his AUM was in today's dollars, like 2024 dollars. So I'm comparing against the world's best. That, like, literally, I'm using Buffett as to what was the size of his AUM at, I think it was 38 or 39 when he left Buffett partnership and he was setting up Berkshire. Oh, not setting up. He was predominantly using Berkshire Hathaway as his vehicle. And so I've got that on an Excel file. And so those are the kind of things we use to compare. There's a few other good examples of people we try to compare to, what their size of their business was in the age of their business, of their company, and in the age of the founder CEO. So we do a bit of that. We've never had any mentors, physical mentors, no, ever. I don't know how. We just haven't. All our mentors are through books, through each other. We've built RDCP with each other and then hiring smart people. A couple of decent advisors on the outside, but really bringing in really smart people to help us grow. Yeah,
I think we just compete against our own goals, the goals that are being set. That's the competition, not against someone else or some other company. Just because we're doing everything in our own way. So I don't even know who would compete with, or what would be the point of that, to be honest. Just because we're trying to build something, we have a vision and we're trying to get there. So it's not against someone, or it's for us to think that we better or bigger than that company. That's not the point. We're trying to achieve something which is our own vision.
Yeah.
So we're just going towards that.
Yeah. So yeah, we don't. It's public data on other companies that have been built successfully.
Yeah.
That we try as best as possible to mimic. I then try to use as much data as possible to determine, what is the average multiple for a HoldCo? Are we, based on the size of our EBITDA, what's our value? Is that in line with the growth that we're? And I'm giving real data, by the way. I'll send you the annual report once it's ready, Mick. But annual letter, I mean. But yeah, I have a whole section on 20 comparables. And these are some of them are HoldCo, some of them are single corporations where they've done a buy and build just in industrials, and now they call themselves a chemicals company. So these are companies we're trying to mimic, trying to copy, and then trying to see how they trade. They're all listed, and they're from 20 million EBITDA to 150 million EBITDA. So we're in the middle of that roughly, obviously towards the bottom end. But we're trying to see, we value ourselves at about 15 times, whilst the average trading multiple, because I've just done this data yesterday, I can tell you is about 26 times. And this is between Europe, UK, Canada, US. So it's quite a wide set of data points, which is quite useful. So that's really what we compare to.
One more important question I forgot to ask. How have you been able to do all this without giving away equity? Giving away equity, probably maybe I'm getting it wrong, easiest way to motivate people, incentives, things like that.
So we've got incentivization, profit share schemes, EMI shares, they call them in the UK, for senior management and so on. So we've got them at the portfolio companies level. And we're not trying to be like stingy or greedy. We like sharing with our senior management, and we want them to win and get wealthy alongside us. But it's more around, we don't want to go give away 30% of HoldCo and raise 100 million. It's more that's what we do not want to do. But to answer your question, how have we been able to do it? It comes down to that psychological ability to withstand risk. And what that means is, I'll give you a very good example. A friend of mine built quite a successful HoldCo in Canada. And he did a bunch of deals. And in year 3 or whatever, he had a bunch of earn-out considerations due. But he didn't structure it properly. So they were all due by this one parent company, which had all these subsidiaries. So if he didn't pay it, they could sue him and take him down. And in that moment, I think he gave away like 80% of his equity because he had to go raise capital to be able to pay for these earn-out considerations. So that's a bad example of how not to structure deals. And that's the reason a lot of these holdcos, maybe he anticipated a lot of growth that he'd be able to cash flow these payments when they were due. So to withstand risk point, go and talk to them when year 3 happens. Hey, look, we thought business is going to grow by X. It hasn't grown. Can I pay you over 24 months instead? Can we do that? Can we? Mm-hmm. So many people are not, when they're starting out their business or just deciding to become an acquisition entrepreneur, are they willing to be able to have such conversations? Are they willing to withstand what if they say no? What does getting sued mean? Which entity are they really going to sue? What does that all mean? So it's those kind of, that's why people raise equity. The simplest thing to do is raise some equity. Mm-hmm, mm-hmm. Cash solves all problems. That's just a fact of life and business. Cash solves all problems. And what's your ability to withstand not having said cash and being able to negotiate otherwise? Yeah, essentially, yeah, bringing a knife to a gunfight kind of thing. And not everybody can do that or is willing to do that. And some people just don't like that stress. They don't need it in their lives. And I don't recommend it to most people, frankly. But we've gotten good at it. We've gotten good at structuring. We're very upfront with Grayton is a good example. Sellers went in eyes wide open. They're fully aware that they're subordinated to the senior debt lender. There's monies that are due to them year 1 and year 3. But if the business doesn't grow a certain scale, they're going to have to be delayed on getting it paid. So in certain situations, as we've gotten bigger and better at doing what we do, we're just having frank conversations. And some sellers are very receptive to it. They appreciate the transparency. And Grayton is like the perfect example where we had such frank conversations and they were like, look, we appreciate it. Hopefully we get paid in year 3. If we don't, we'll get paid in 6 months after year 3. It's not the end of the world. And that's a great place to be. That is the place to be. And that requires confidence in negotiation, confidence that you don't push so hard that the deal falls away. Yeah. And is that operating in the gray area, which most people just don't like. People like black or white. This gray area is where we thrive. It's not easy. I don't recommend it to many people, but yeah, I think that's the main answer to your question. Why is nobody else doing it? Because it's not scalable. We scaled it, but we scaled it and we're doing really, really well and we have a strong pipeline, but.
Okay, last 4 questions. How old are you guys?
I'm 34.
I'm 33.
Favorite book?
For me, it's going to be a book about children's psychology. So that's actually hard, which is actually the last book that I read, which is about how to bring up children and, how to bring them up. I grew up in Eastern Europe, so I was, my childhood was very different to my children's childhood. And I just want them to grow up well-rounded, emotionally open human beings. So yeah, I read a lot of books about kids, to be honest, during the past 2-3 years. That was my main focus point.
I think that's, by the way, Mick, that's why we're balanced, good balanced parents and business people, because we bring a bit of both into everything. My favorite book is probably Outliers, I think it's called, which talks about some of the best CEOs from like 1950s and to 2000, something like that. It's a great book.
So we talked about Buffett, but what about the best investment advice, particularly?
That we've received or that we would give, or doesn't matter?
You would give.
We're a combination of investors and deal makers. You know,
Yeah.
like if you're a good deal maker, you can almost be an average investor. You know, like if do you get what I mean? Because maybe that's the advice. Be a better deal maker. If you become a really good deal maker, you will by default become a really good investor, because there's limited downside for you as the HoldCo or investment vehicle. I think that would be my advice. Yeah, become a better deal maker.
That's it. Thanks a lot for doing this. I really wanted to do it live. Couldn't do it this time. We had our second kid, but maybe in the future. Thanks. Maybe in the future we can do part 2 live in London in your office.
That'd be amazing.
Yeah, for sure.
For sure.
Okay. Thanks again for doing this, honestly.
No problem.
Thank you.
No problem.